Welcome to Illuminati Silver. We tell the truth about silver. Today is Sunday the 26th of January 2020, and yesterday we published our Gold and Silver Weekly Update for the week ending the 24th of January, and have placed a link to it in the description box below. Now, in yesterday's video, we highlighted that this coming week, a raft of economic data will be published, most of which could have an impact on gold and silver prices. In fact, it's the busiest data week for the whole of January. Now, whilst there are a number of notable reports, which include new home sales, durable goods orders, core capital goods orders, advanced trading goods, personal income, consumer spending, and the core price index all for December, and the consumer confidence index and consumer sentiment index for January, and not forgetting GDP figures for quarter 4, perhaps the most important of the data set is the FOMC announcement due on Wednesday on interest rates, including Jerome Powell's press conference, which is held immediately after the announcement. So it is this aspect of next week's data we shall deal with today, as it is likely to have the greatest impact, if there is an impact at all. Now, we say that because we are expecting rates to remain unchanged. However, the most important aspect is what Jerome Powell says afterwards. It is also not unreasonable to expect that the FOMC will be given a degree of prior notice of the data to be published after its announcement, so as not to be totally wrong-footed in its interest rate decision, for it would be totally humiliating if it found itself in the position of having to reverse any decision immediately afterwards because new data, that is, new data published 2 days later, forces markets to react significantly. So it would be somewhat naive of us to believe that the Fed does not have a good indication of what is about to be reported when it gives its interest rate announcement. So, where are we in relation to interest rate changes this month, and possibly for the duration of 2020, especially as the Fed found itself in the position of having to cut interest rates 3 times last year, leaving the Fed funds rate targeted between 1.5% and 1.75%. Now, we've already expressed our view that rates will remain unchanged, but that view is supported by many others. Between January the 20th and 23rd, a survey was carried out by Bankrate with 12 top financial and economic experts, of which all 12, that is 100%, anticipate that the Federal Open Market Committee, the FOMC, will leave borrowing costs alone, and they hold this view with a confidence level of 97%. In other words, each of these 12 economic experts are 97% confident that rates will remain unchanged. ING Group, a Dutch multinational banking and financial services group with a revenue in excess of $18 billion, reported to its clients in the last few days, quote, "The Federal Reserve is widely expected to leave monetary policy unchanged on the 29th of January. But with hints of economic softness amongst the equity market euphoria, we continue to see risks skewed towards lower rather than higher interest rates later in 2020, unquote. Now, we shall all learn, as Wednesday approaches, that virtually no one is expecting a rate cut this week. And we will quote what the Fed stated in December when it decided to keep its rates on hold then, quote, "The committee judges that the current stance of monetary policy is appropriate to support sustained expansion of economic activity, strong labor market conditions, and inflation near the committee's symmetric 2% objective," unquote. It was also reported at that time, quote, "New dot plots, which map 17 policymakers' projections for where interest rates may go in 2020 and beyond, show the median FOMC member predicting rates remaining in the range of 1.5% to 1.75% by the end of next year, which is 2020. Notably, no member of the FOMC sees the case for further accommodation, with only 4 members predicting one 25 basis point hike. The median dot projects one rate hike by the end of 2021 and another hike by the end of 2022, end quote. Now, to perhaps support the view that there will be no change, we saw on Friday, for example, that US Treasury prices advanced, pushing yields lower for a fourth straight session, as news of the latest coronavirus spreading outside China continued to undermine what experts and investors call risk appetite and spurred demand for safe haven assets. You see, the US 30-year yields declined to a nearly 3-month low, while those on benchmark 10-year notes dropped to more than 2-month troughs. US 2-year notes also slid, dropping to a 2-week low. 30-year yields, 10-year notes, and 2-year notes all falling in terms of yield. US 10-year yields have lost now nearly 15 basis points in the last week alone, their largest weekly drop in 3.5 months. And 30-year yields have fallen roughly 16 basis points last week, the biggest weekly decline in 4 months. So against this backdrop, we certainly cannot see the Fed lowering rates when yields are already falling. Having said that, if this virus does spread significantly outside of China, and even significantly within China, then this will adversely affect stock markets, as well as trade. And in that scenario, if it's particularly pernicious, we can see later in the year the Fed having to lower rates, but certainly not in the next few months. So, whilst the Fed has stated that it is more likely to raise rates than lower them, our assessment this early in 2020, and we have to please accept the fact that a lot can happen over the next 6 to 12 months, but our assessment this early in 2020 is that we will see an interest rate drop because of what is happening in other countries, most noticeably Europe, UK, and what may now occur in China. There will also be huge political pressure from President Trump to keep the equity markets bubbling in an election year, and especially just prior to the presidential election. And so we can see one cut in 2020 as a near certainty. And if the virus does spread considerably, then 2 cuts may be necessary. But 1 is our prime prediction for 2020. But we are at least 97% confident it is not going to happen in January. Now do let us know whether you agree or disagree. And meanwhile, thank you so much for listening. And if you haven't already done so, please subscribe to our channel and press the bell sign so that you're notified of our videos as and when they are published. Not forgetting that we've placed some important links to previous videos and sites and books in the description box below. On Thursday and Friday of this coming week, more likely on Friday, we shall be publishing our gold and silver price predictions for 2020. And finally, we would like to take this opportunity to wish, controversially, Greg many happy returns, as it is his birthday today. Rumour has it he is 21 yet again, but for how many times, we're a little uncertain. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.